Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know first, Anthropic's new AI agent triggers a massive sell-off as Wall Street fears disruption in the legal and ad tech industries. We'll analyse why this AI-driven sell-off is a turning point and how it could affect the competitive dynamics of the entire software industry. Second, NXP forecasts 20% growth from its physical AI chip strategy, yet its stock drops 5% on Wall Street skepticism. We'll explore how repurposing automotive-grade chips could transform industrial automation, despite investor doubts about the company's overall growth. Third, AMD's stock plummets 7% as its AI chip forecast reveals a struggle to challenge Nvidia and a reliance on risky China sales. We'll examine how Nvidia's software moat and the AI productivity paradox may impact AMD's product roadmap and its ability to compete. Fourth, Nintendo faces a critical memory chip shortage for the Switch 2 as the AI boom threatens to drive component prices up 95%. We'll explore how this AI-driven component shortage could transform the console industry's business model and threaten Nintendo's mass market appeal. Fifth, China's Comac challenges the Boeing-Airbus duopoly as airlines face 7-year waits, but it faces major certification and supply chain hurdles. We'll analyse why the rise of a state-backed competitor is a turning point and how it could affect the competitive dynamics of the global aviation industry. A single AI update just triggered a massive sell-off across the stock market, with one major company on track for its biggest daily loss on record. The culprit is AI developer Anthropic. It just launched new plugins for its Claude Cowork agent, a tool designed to automate high-level tasks in legal, sales, marketing, and data analysis. So what's the technology behind this? These Cowork agents are not yet fully autonomous replacements for entire professional workflows. Think of them more as incredibly advanced co-pilots. They are built on Anthropic's most capable model, which allows for extended thinking to plan and execute multi-step tasks, but they still require clear instructions and human oversight. They are powerful assistants, but not yet full replacements. A while back, we walked through data showing AI agents can slash per task costs by up to 95%, and we're already creeping into coordination roles. Today's launch doesn't suddenly make humans obsolete, but it does push more of that cost-saving capability into everyday workflows, which is exactly what spooked investors. That move sparked immediate worries of an AI-fueled disruption in industries that were, until now, seen as major beneficiaries of the AI era. The market reaction was swift and brutal. Thomson Reuters, owner of the massive Westlaw legal database, saw its stock slump by nearly 18%. Britain's Relics, another legal analytics provider, fell 14%, its biggest single-day drop since 1988. Other professional services firms like LegalZoom, FactSet Research, and Morningstar were also hit hard. The shockwave didn't stop there. It slammed into the advertising world, with giants Omnicom and publishers diving 11% and 9%. A few days ago, we mentioned how retailers were embedding assistance at the point of sale. Today, the focus shifts to white-collar profit centers, where that same agent plus plugins model now threatens premium software and services. This isn't just a random market panic. As one portfolio manager said, sometimes the market just shoots first and asks questions later. But the real story is a fundamental shift in how investors see the future. We previously analysed warnings that AI would be used as cover for cuts, and we've noted that AI was cited in over 55,000 layoffs last year. Now, those fears are being reflected in valuations. According to Morgan Stanley, investors are overwhelmingly bearish, worried that companies will be unable to maintain growth in the face of this new competition. The core conflict is that AI now directly challenges the very business model that made these companies so valuable. You see, incumbents like Thomson Reuters aren't just sitting still. In fact, they've committed over $100 million annually to AI and even acquired an AI legal tech company for $650 million. The problem is, this creates a dilemma. How do you innovate with AI that makes work more efficient without cannibalizing your own profitable per-user business model? Even Anthropic's own CEO has warned that AI is becoming a general labor substitute that could cause unusually painful disruption, which collides directly with per-seat pricing. An analyst at Schroders explained that investors are aggressively repricing these sectors because the speed of AI advancement makes their long-term value harder to defend. The threat is clear. New AI tools allow businesses to do more with fewer staff, directly attacking the traditional model of charging per software user. What's truly significant here is that this plugin strategy from Anthropic points to a massive potential change in how all software works. The future may not be in standalone apps, but in specialized skills built on top of dominant AI agents. Think of it like the revolution caused by Apple's App Store. This is a similar paradigm shift, but for AI. It suggests a future where these big AI models become the central platform and other software just becomes a feature within them. And yes, even as some CEOs try to soften the optics with friendly agent rollouts, markets are reacting to margins, not mascots. The fear is no longer abstract. For entire industries built on data and professional knowledge, the AI disruption isn't a distant threat, it's here and it's hitting their bottom line. We've just seen how AI software is shaking up entire industries. Now, let's turn to the hardware side, where one company is betting big on what it calls physical AI, but Wall Street isn't buying it. Chipmaker NXP Semiconductors announced it expects its industrial chip segment to skyrocket, growing 20% in the first quarter alone. The new CEO, Rafael Sotomayor, is crediting this surge to something he calls physical AI. So what exactly is physical AI? Interestingly enough, the term itself is a clever piece of branding. What NXP is really talking about is what the industry often calls edge AI, or the industrial Internet of Things. The company is trying to stand out by focusing on how this AI is physically embedded into devices, making them smart right where the action is happening. This is a hot space, and competitors like ST Microelectronics are right there with them. This isn't the AI in data centers. This is intelligence being built directly into industrial systems for things like logistics, automation, workplace safety, and robotics. Sotomayor stated it clearly, the fastest growing part of our industrial portfolio is the products that have inherent AI capabilities. But here's where it gets interesting. The technology fueling this industrial boom isn't new. It's the same tech NXP originally developed for the automotive industry. The CEO explained that all the technology that we develop for automotive, we actually put to work elsewhere in industry. And this is a brilliant move. You know, automotive grade chips are built like tanks. Research shows they're designed to operate in extreme temperatures from -40 all the way up to 125 degrees Celsius. They have to withstand vibration, humidity, and are built for a lifespan of over 15 years. So when you take that level of reliability and put it into a factory robot or a drone, you're creating an incredibly robust system. The very same intelligent systems that make a car function are now going into drones and robots on the factory floor. The situation presents a fascinating duality. On one side, you have a hot new strategy and a 20% growth forecast. On the other, the stock actually fell 5% after the announcement. If you zoom out, you'll see investors are looking at the bigger picture. In their most recent financial reports, NXP's overall revenue actually fell year over year, and their profit margins contracted. On top of that, the company announced their current CEO will be retiring, which always introduces a bit of uncertainty. The market is essentially saying, we hear your exciting forecast, but your recent performance makes us nervous. The core conflict is between the company's bold vision and a skeptical market. Analysts say that after years of weaker sales, investors want to see more than just a forecast. They want hard evidence of durable growth. The market is demanding proof, but NXP is doubling down. The company believes the worst of the car maker inventory corrections are over and that the true growth prospects of its new products are now ready to be unleashed. Their strategy isn't to go head-to-head with giants like Nvidia on raw power, but to win on efficiency and integration. They're betting that for every robot that needs a supercomputer, there are 100 more that just need to be smart, reliable, and efficient. NXP is betting its future on turning car technology into factory intelligence, convinced the market's doubt is temporary and the real growth is just getting started. Speaking of chip makers facing a skeptical market, AMD is in an even tougher spot. The company just saw its stock plummet nearly 7%, and the reason why is sending a massive signal about the entire AI industry. AMD is locked in a brutal fight to catch the undisputed king of AI, Nvidia, but its latest sales forecast was so lackluster, it has investors questioning if it can truly compete. A while back, we talked about how GPU demand rides on a mountain of CPUs. Today's AMD story hits a different nerve. Not shortages, but whether demand is as durable as the market priced in. To challenge Nvidia, AMD has launched its powerful Instinct MI 300X chip. On paper, it's a beast with more memory and faster bandwidth than Nvidia's celebrated H100 chip. But the battle isn't just about hardware. The true kingmaker is software. Nvidia has a massive head start with its CUDA platform, which over 4 million developers use. As we've discussed before, that developer lock-in is the moat. AMD is trying to catch up with its open source software called ROCm, but getting developers to switch is a monumental task. But the rabbit hole goes deeper. Digging into the numbers reveals that a huge part of AMD's recent performance wasn't from sustainable growth. It came from a one-time $390 million boost from China-bound chip sales. Without that single license, their key data center segment would have missed estimates entirely. And this reliance on China sales is a huge red flag because these chips are specifically watered-down versions designed to comply with strict US export controls. The problem is, this revenue stream is incredibly risky. The US government is continuously tightening these rules, and there's no guarantee this loophole will remain open. Relying on it for growth is like building a house on a foundation of sand. One top analyst put it bluntly, stating that without that China boost, AMD's near-term AI numbers are not really inflecting. In other words, the explosive growth investors were expecting just isn't there yet. Now, AMD's CEO Lisa Su insists demand will accelerate sharply later this year. But this comes as its main rival, Nvidia, is reportedly making a staggering $20 billion push with partners to cement its dominance. This brings us to a phenomenon experts are calling the AI productivity paradox. Global corporate investment in AI is in the hundreds of billions, yet actual labor productivity growth is nearly flat. One study found that while developers saved hours per week using AI coding tools, their overall output didn't really increase because of other bottlenecks. After all, it's not enough to just buy the fancy AI tools. You have to fundamentally change how you work to see the benefits, and that takes time. While AMD fights a titan for a piece of the AI pie, the bigger story is that the entire industry is facing a moment of truth as the market begins to question if the AI gold rush can truly deliver on its promises. That intense competition in the AI chip market is having some unexpected consequences. For Nintendo, it's creating a potential nightmare for its upcoming Switch 2. The company's stock just cratered, dropping over 10% in a single day, right after announcing a 24% jump in profits, and that its original Switch is now the best-selling console in its history. So what's going on? The gaming giant is being squeezed by the AI boom. This is a global issue because most of the world's memory chips, the DRAM that Nintendo needs, come from just two places, South Korea and Taiwan. We're talking over 70% of the global market, meaning any disruption in that single region can create a massive shockwave. Nintendo is facing an unprecedented shortage of memory chips. The demand from AI and data centers is so massive that the price for the specific memory Nintendo uses is projected to skyrocket an unbelievable 90 to 95%. Now, get this. The memory chips AI needs, called high bandwidth memory or HBM, are fundamentally different and consume about 3 times the manufacturing resources as the standard DDR5 memory used in consoles. So when a company like OpenAI reportedly secures 40% of the entire global DRAM capacity for 2025, it's not just taking a piece of the pie, it's taking the whole bakery. This forces memory makers like Samsung to prioritize high-paying AI clients, leaving companies like Nintendo fighting for scraps. One top semiconductor CEO warned this shortage could persist through 2027. This has led one industry expert to predict what was once unthinkable. Nintendo may have to raise prices on its already expensive Switch 2 console. This threatens to break the entire business model of the console industry. For decades, the strategy has been to sell the console at a loss and make profit from games. But we're already seeing this model crack. Just last year, Sony raised the price of the PS5 mid-cycle, a move that was once unthinkable. If Nintendo is forced to do the same, it signals a permanent shift. This is especially dangerous for Nintendo because its audience is fundamentally different from Sony's or Microsoft's. They rely on families and casual players who are much more sensitive to price. In November of 2025, overall console hardware sales plummeted 27%, Xbox sales were down 70%, and PlayStation 5 sales fell by over 40%. But Nintendo, their sales only dipped about 10%. This shows their audience is more resilient at the current price point, but a significant hike could shatter that loyalty. This is where the situation takes a more complex turn, and it's a trap Nintendo has fallen into before. Remember the original Wii? It was a cultural phenomenon, but its successor, the Wii U, was a commercial disaster, selling just 13 million units compared to the Wii's 101 million. Investors see that history, and they're worried that the Switch 2 could be another Wii U moment, a victim of its own predecessor's impossible success. Now, with a component crisis looming, the pressure is mounting. One senior analyst put it bluntly, calling 2026 a make-or-break year for the Switch 2's entire future. Despite smashing profit records, Nintendo is now in a high-stakes battle against the global AI industry for critical parts, a fight that threatens not just the price of its new console, but the very foundation of its mass-market appeal. From a shortage of tiny chips to a massive bottleneck in giant aircraft, supply chain crises are reshaping entire industries. In the aviation world, a jaw-dropping 7-year wait for new planes from Boeing and Airbus is creating an opening for a new powerhouse to enter the ring. China's state-owned plane maker, Comac, is making its move. The Director General of the Association for Asia-Pacific Airlines didn't mince words, calling the current market an oligopoly, adding, "We have been waiting for this for a long time. Comac is a welcome introduction." Here, we're seeing a clash of economic models. For-profit companies like Boeing and Airbus are now facing a competitor that is state-funded, may not need to be profitable, and has a protected domestic market. This is a playbook we've seen before in sectors like high-speed rail and solar energy, and it completely changes the rules of the game. This isn't just wishful thinking. The head of the International Air Transport Association, Willie Walsh, just went on the record with a bold prediction. He said, 10 years, 15 years from now, we'll be talking about Boeing, Airbus and Comac. Without question, they will be a considerable player in the future. The conflict is already heating up. Comac is targeting the massive Southeast Asian market, and airlines are listening. Brunei's Gallop Air has placed a large order. Cambodia is planning to buy planes. And the CEO of the Philippines, Cebu Pacific, says Comac's jets could be an attractive offering in the 2030s. To make that happen, China is actively building a global maintenance, repair, and pilot training network from scratch. They've already signed partnerships with established maintenance providers and are even leveraging their Belt and Road initiative to build a parallel support ecosystem. But the story doesn't end there. Comac faces a brutal uphill battle. European certification, a critical step for global sales, could take until 2031. This isn't just about safety checks. Many in the industry believe the long and complex certification process also acts as a political and economic gatekeeping tool, protecting the Boeing-Airbus duopoly from a state-subsidised rival. And there are serious questions about its production. While Comac claims it has over 1,000 orders for its C919 jet, so far, only a dozen have actually been delivered. Believe it or not, the vast majority of those orders aren't from independent commercial airlines. They are from Chinese state-owned airlines and state-affiliated leasing companies, suggesting many are politically motivated commitments rather than purely market-driven decisions. But perhaps the biggest hurdle of all is a massive technical vulnerability. The C919 jet is heavily dependent on Western core components, especially its engines, which are made by a joint venture between America's GE and France's Safran. This creates a strategic choke point, making the entire program vulnerable to tech sanctions. While China is racing to develop its own engine, the CJ1000A, it likely won't be ready for mass production until 2030. The battle lines are drawn, airlines are desperate for a third option, and top industry leaders are predicting a major market shift. But with massive certification, technical, and production hurdles ahead, Comac must now prove it can turn its sky-high ambition into a reality that can challenge the two giants that have ruled the skies for decades.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.